Welcome to Financial Issues, where we help you steward faithfully by honoring God with your investments. Now listen in as we give you the practical tools and advice you need to become a biblically responsible investor.
This is Financial Issues, where we help you defund darkness and fund the light by investing with biblical integrity. Great to be back with you all this morning, folks. Monday, January 12th, Seth Udinsky, Sam Case, and your host, Mark Manila. Mark, welcome back, brother. We missed you on Friday. Great to have you back.
Well, thank you. I did catch the show Friday morning, and I was very impressed. In fact, I was wondering if you guys were going to have me back on Monday, since you didn't
Mark,
need me anymore.
There was never a doubt. There was never a doubt. But thank you for coming back. It's great to have you back. And folks, great to have you all with us as well. We missed you this weekend. Phone lines are wide open. If you didn't get a chance to call in on Friday, now's the time to do it. 610-363-1110. Again, the number is 610-363-1110 if you want to join the live conversation. Today's show, we got a good one for you, folks. What should you do if you have a lump sum of money to invest? Mark's going to give some great insight on that. Also, the official chip maker of the United States government continues to enjoy a stock run-up.
State sanctioned.
That's right, state sanctioned. I said steak sanctioned. I must be hungry for some steak this morning. I wonder if those things are related. We'll find out. Mark, first and foremost, though, we touched on this last week as we came out of the Christmas season, but didn't get as much of an opportunity to hear your thoughts on it. So we saw online Christmas shopping hit some new records. Sam, would you give us the details on this one more time?
$258 billion this year, November 1st through December 31st. Those numbers rose nearly 7%. That was less than 2024, where we saw a 9% increase, but still that blew out of the water expectations. However, the bad news is that buy now, pay later plans at the same time also reached a record high. That was $20 billion, and that was up almost 10% year over year.
So, Mark, what do you think about this? Does this tell us anything about how consumers are feeling coming out of the Christmas season?
Well, the first thing that hit me when the two of you started talking about this is, one, do you remember the run-up to Christmas, how they're saying spending is down, spending is down? This may be the worst Christmas in 5 years, 10 years, as far as spending and stuff, how they were constantly, the media was constantly saying that spending was going to be less this year than before. And obviously, they were totally wrong, as usual. And it was just narrative to try the affordability thing, to try and entrench that a little bit more. They were saying people just can't afford Christmas anymore. Well,
honestly,
they were totally
Mark, that's
wrong.
why this headline caught my attention. It's like, what do you know? The media was wrong again.
How does that happen? Outside
it's almost
of
like
total
there's a pattern here.
Yeah, right. Yeah, I think the consumer spending, though, what it did show me is that there's confidence in the future of the markets. They're saying, hey, I'm feeling good about things. Yeah, I'm sure there was a little bit of, I'm just tired of being living in this environment with everybody telling me that everything is bad. I'm just going to move forward and, we're going to do Christmas. And yeah, so I think there was confidence there, confidence in that they felt good about what they could do. And then the whole idea of buy now, pay later, or credit card debt, that kind of stuff, that concerns me. My feelings about debt. God warns us about it over and over again. We got to be very careful. But there's a little bit in there that we need to look at. When somebody takes a credit card, they do it for, let's just boil it down to one of two reasons. One is it's an absolute necessity, and I need to feed my children or clothe my children or something like that. Or two, I feel pretty confident I can pay this off in the near future. I feel confident about the economy. I think it was a little bit of both. There's always some of one and some of the other, but the confidence level is growing and growing in this economy because of what the administration is doing. And people are starting to see that. They're starting to see that things are coming around. There's foundations being laid. There's things being turned around here. And they're feeling confident about the economy, their jobs, the ability to have a job, the ability to make a decent wage. They're seeing their income not only keep up, but surpass inflation, and they're feeling very good about it. So I think one word that would describe it all is optimism. And despite the media, despite the left media and the anti-Trump media and the anti-conservative media and the anti-God media,
But you repeat yourself.
Optimist. I mean, yeah, but I repeat myself. Yes. Thank you.
That's good. 610-363-1110. Folks, you want to learn more about our ministry, check it out, financialissues.org. You can become a partner there today. Speaking of optimism, Mark and Sam, you know what else is feeling optimistic is Intel stock, which, Sam, as you mentioned, is the official state-sanctioned AI chip maker of the United States government. Apparently feeling pretty good after Trump visited their CEO. What can you tell us about this?
Jumping 7% on Friday. Nothing to sneeze at there, Seth. Trump did meet with their CEO Lip Bu Tan. That's my middle name, by the way. Lip Bu Tan. No.
I did not.
No, I wish,
Lip Bu
right?
Tan, huh?
Yeah. Who knew? The world's a strange place. But yeah, Trump met with the CEO on Friday, having a very positive effect on the stock. By the way, the stock's value has more than doubled since the U.S. took that $8.9 billion stake in the company last August. That's a 10% share of Intel, and it also makes the U.S. Intel's single biggest shareholder at the same time. After that meeting on Friday, Trump posted on Truth Social about Intel's recent chip that it launched, saying it was designed, built, and packaged right here in the United States of America.
Okay, so Mark, I'm going to be honest with you. I don't like this. I don't like the U.S. government taking a 10% share in what should be just a regular operating company. But what do you make of this? Maybe I'm missing something here with the U.S. government taking such a large stake in a company like this.
No, my initial reaction is very similar to yours, Seth. I really have concerns when the government starts picking and choosing different companies to be winners. And that's effectively what's happening here. But if we look at things historically, let's go back to when all the car manufacturers were going bankrupt and the government stepped in. I really didn't like that, especially since they negotiated everything and a lot of people lost money. Bonds were not paid. Just all sorts of stuff went on. But we still have cars in the U.S. We still have GM. We still have, Ford didn't take any of the buyout back then, and the government didn't own any of Ford for a while. But eventually, the government got out of the car manufacturing ownership over time, sold its portion off. But I didn't like what happened to a lot of investors, a lot of bondholders, a lot of people as the unions took more and more ownership as the government gave it to them and whatnot. So there's all sorts of ugliness that happens. But on the other hand, there are certain times in the world where we have to look at things from a little bit different perspective. We were losing the battle on chips. We were dependent upon our enemies for chips for our future and our current armaments to protect us from the world and to keep the world a stable place. Something had to be done. Is this my most favorite thing for us to do? No, but it made sense to make sure that we have the technology that we need to stay beyond to be reckoned with by the world instead of being indebted to and dependent upon. So it's a very complex and confusing situation. The sooner we get out of it, the sooner that Intel becomes the company it used to be and develops the chips we need and builds the factories we need, because that's one of the reasons we were putting the money into it as a country. Instead of just lending them the money or whatever, the government took ownership in it and put money into it, and now has some say on the board and whatnot to keep things going forward. As soon as we get out of it, though, the better I feel. Once we establish everything we need. It's kind of almost like wartime acts where they take over the assembly lines as necessary to build armaments and bombs and bullets and everything needed to win the war. It's almost like that, except for this war isn't so much men on the field shooting at each other as it is technology and everything else, so we don't have to do that.
It's the AI arms race.
Yeah,
exactly. Yeah, it really is. Yeah, Mark, it's interesting that you bring that up because it doesn't always happen in history, but I have noticed that our government's guilty of this and others are as well, of taking that power, like you said, during war times, declaring a state of emergency and then conveniently never giving it back. And I'm hopeful that this doesn't happen this time. But sounds like what you're saying is we don't have, it's not, panic alarms just yet to be able to see something like this. Hopefully this was a necessary maneuver in this AI arms race.
Well, I think we should be alarmed, and that's what'll keep it from happening wrongly. Just like if people did not get alarmed and start raising their voices when we took shares in GM and the other car manufacturers, they never would have gotten rid of it. Or if they did, they would have done it in a way that just benefited their own people. So I think it's very important that we stay at arms with it and hold them to the fire. And in doing so, we can see it play out possibly for the best of Americans and hopefully for the world in that.
Every day, kids all across America are coming to school with some kind of hidden pain.
I've seen kids come in who are just so confused about what's right and what's wrong, just having no idea that God loves them. And this just breaks my heart. Crossroads has the opportunity to bring the Word of God right into the public school, to reach children right where they are.
And when we see that happen, we see God changing lives.
We want to see kids not only come to Christ, but pursue a lifelong relationship with Him. And so local churches are uniquely positioned to disciple those children as they become young adults and through their lifespan.
Crossroads comes alongside a church and provides that church with a club structure, curriculum, training, and ongoing coaching for them to run these outreaches in public schools.
If you are burdened for the children of America, consider making a donation to Crossroads Kids Club. For more information, visit reachOurschools.com. That's reachOurschools.com.
In a world where financial decisions can feel overwhelming, it's easy to lose sight of what truly matters: our family, our faith, and our future. With financial issues by our side, we can invest knowing that our financial decisions are in line with our values. Take the first step today and become a financial issues partner to access rich online resources, training tools, and guidance for biblically responsible investing. Head over to financialissues.org and learn how to invest your money in a way that honors God. That's financialissues.org.
Did you know that an unborn baby's heart beats at an average of 120 times every minute? That steady rhythm, that precious sound, that's the sound of life. Preborn partners with local pregnancy clinics across the nation to help mothers choose life, providing free ultrasounds, counseling, and the gospel of Jesus Christ. To give, just dial pound 250 and say the keyword baby. That's pound 250 baby.
Hey folks, today's show is brought to you in part by our friends at Preborn. We got a story later on that we might touch on having to do with the work that Preborn's doing, but boy, we so appreciate them, the work that they do in saving babies and bringing the gospel to mothers and fathers and to whole families, really. It's really a legacy just completely turned around of an unplanned pregnancy or an unwanted pregnancy turned into a child who makes it into the world with parents who have the chance to hear the gospel and to share the gospel with that child. Just amazing, Mark. I love it. Preborn.org. It's a place to go with them. All right, Mark, so let's get to this here. The investor crash course for the new year. I'm excited to hear about this, brother. We have a question here that I'd love to hear your thoughts on. So the question basically is this. If I have a lump sum of money I want to invest, and or if I'm investing for the first time, what are the 3 to 4 steps that I could take? And I will say, Mark, we have a partner, Lee, who's 64, who's asking a very similar question. He inherited about $41,000, and he's trying to figure out how to disperse it over the model. So what steps to take?
Yeah, the question is excellent, and there are certain steps that you should take. And the first one is to define your goal for this money. That's so important. Not just, well, I want to get it invested, but why? What are you going to use this money for? What's the time frame for accessing this money? Define your goal for this money, because until you do that, you really can't determine the next steps going on. Otherwise, it's just, well, throw it in an investment account. You know, what do they say? If you don't have a destination, any path it will work. So get your goal set, get your path set, so you know time frame and what you need to do with that money. There's certain questions you need to answer so that you can move on to the next step. And the goal would include the time frame, because based on your time frame and liquidity assumptions, you can choose the right investment type of account to use. Different investment accounts have different liquidity options and also have some penalties for not holding at certain times. So you have to know that before you move on. So if this is like, I'm 22 and I'm going to retire in 43 years, you know, you have 43 years before you supposedly are going to use that money. There may be some other things in between there that money wants to be helped with. So you have to really clearly define the goals. So let's go over the different accounts so you can see how this applies. First of all, an individual account. That's a typical investment account. Anybody can open it. There's no income requirements for it like IRAs. There's no earned income. If you got money, you can put it in there and you can get an investment. So if you think you'll need the money prior to 59 and a half, this would be the most likely type of account to use, because there is no limitations on when you put your money in or when you take it out. There's no limit on the funding amount. So if you have $1.6 billion you want to put in it, you can put $1.6 billion in it. If you have $500, you could put $500 in it. There are some tax advantages to it, or could be, for long-term capital gains. Usually long-term capital gains are substantially less than your normal income tax rate on earned income. So you have some advantage there, and you have liquidity. So individual accounts, the positive aspects are liquidity, some tax advantage, and no limited on the funding or accessibility. And then you move to a tax-deferred account, like a traditional IRA. If liquidity is not important until after 59 and a half, this is a good type of account for you. The reason we say that is because there are restraints and penalties for early withdrawals prior to age 59 and a half. There's a 10% penalty. There are some exceptions, but they change way too regularly for me to depend on them. So,
and Mark, those are very extreme life circumstances too that you probably wouldn't want to face anyway. You know, an unexpected death, something like that. Yeah.
Yeah. Well, yeah, a first-time home buyers, you can use some of the money. Yeah. I think that's still in there. They didn't change it this year, did they?
As far as I know. But
see, just having to ask that question tells me not to rely on it.
There you go.
Okay. But there's also limits on contributions. Seth, this year, I believe it's $7,000 or $8,000 with the catch-up.
It is, yeah. Yep.
So it limits the amount you can put in, obviously restrains on the ability to take money out without penalties. And yeah, there are possible tax deductions. And I say possible because it's based on your earned income levels. The deduction phases out if you start making too much. And there's different things that could keep it from happening where you couldn't utilize the deduction on it. So it's possible tax deduction.
Mark, I'm going to jump in real quick. Just say it's actually $7,500 is the 2026.
Oh,
so it's slightly higher.
Sorry.
And then that catch up is actually $1,100 more. So it's $8,600 in total.
Well, that's great.
It's slightly more. Yep.
Yeah, that's good.
Yep.
That's actually good that it's increasing, but not quick enough.
Yeah, absolutely.
still limit on contributions. If you have a lump sum, you can't put that $40,000 or $100,000 or $1.5 billion like Seth likes to do annually
all the time
into the account.
Yeah. Weekly, actually.
Yeah. Weekly. Okay.
He puts it all in one stock too.
I know.
And I'm not going to tell you what that stock is. No.
Yeah. But then there's the tax-free account, the Roth IRA. Again, if liquidity is not important, short-term liquidity till after 59 and a half, but you'd like some wiggle room, this might be the type of account for you. First of all, I love the idea that you never pay taxes on your gains if you wait to take it out under the rules, which is age 59 and a half. Take the gains out after 59 and a half. If you need to take them out beforehand, then you have taxes on it. But if possible, I recommend setting up a Roth IRA as soon as possible to start the clock on the 5-year rule to gain access to the principal if needed. You see, if you put money into a Roth and you establish a Roth, a clock starts, and after 5 years, you can take the principal, the amount you put in, out without any taxes or any penalties anytime you want after that. So if you put $5 in a Roth, I don't know anybody who opened a Roth for $5, but if you did, that starts the clock, and then you can fund it year by year, month by month, up to the maximum of $7,500 or $8,600 with the catch up. So that's why I say as soon as possible. If you're 14 years old and you have a paper route and you have earned income, start your Roth right now. If you're 27 years old, start your Roth. If you're 60 years old, start your Roth. Get it going. There are limits on contributions. It's part of the IRA contribution. If you're, like we said before.
Mark, can I ask a question with that?
Sure.
Why does the U.S. government have those limits on? Is it just to keep a fair playing field? So they don't want people to take too much advantage of it. Like they say, well, you can't put $1 million into your Roth IRA at one time because that would give you an unfair advantage. Or what's the reason?
They want the taxes, right?
Absolutely.
Right.
That, Sam, you nailed it. They want the taxes. That's the bottom line. For example, when let's see, it was the, in insurance, a lot of insurance salesmen use VULs as a way to put money in and invest in the market, variable universal lives, where you can invest in mutual funds and things like that inside them. But it doesn't get taxed until, you start taking it out and stuff. So when they first came out, people were dumping millions of dollars into VULs because there was no limit how much you could pay in. There was a thing that came out of that they said, well, if you put over a certain amount, then it's no longer insurance, and things start changing on how things are taxed and stuff. So the government just wants to limit how much money you can keep from them. That's the bottom line on it. So they limit the amount you can put into a Roth or into a IRA. Yep. So limit on contributions are there. Again, they are the same limits on a traditional IRA. If you have both, you can't do more than the limit on the limit for both of them. I mean, you can't put in 1,500, 7,500 and 170. Its maximum would be 7,500 in total into both. There are tax-free. This is the neat thing. After 59 and a half, you can take all of it out, tax-free at any time, no taxes. If you put in $100,000 and it grew to $500,000 over that time frame, you can take out all of it without any taxes. So much better than deferring your taxes in the future like a traditional IRA. And there's, like I said, wiggle room, because after 5 years of having it open, if you did need some money for car repairs, replacing the washing machine, or yes, I said washing, not washing machine, washing machine. You can do that. You can pull the money out and at least the principal out after that time. So I really believe this is one of the most important accounts to set up. Now, you don't have to take all your money and put it into it. Let's say that you need more wiggle room than after 5 years, so your investments are really a shorter term investment. You could open up an individual account and a Roth at the same time. Put $500 in the Roth and the rest into your individual account that you're going to use for that down payment on the house or whatever, but get the Roth set up. Okay, so that's the first step. The second step is choose the allocation model. Aggressive growth in income or income. And that's all based on two things: your sleep factor and your time frame. Bottom line on it. So sleep factor is your risk tolerance, and the original goal of the money, the time frame of that. That's what you need to look at to decide on which of those accounts to use. And I listed them in the most volatile to the least volatile, so you could see why we look at it like that. And we can go into that deeper if you want. Part of that is also choosing the investment vehicles. And that's based primarily on the amount you have to invest to maintain a diversification. You can use mutual funds and ETF, which allows greater diversification because each of the mutual funds or ETF you have will have multiple tens, hundreds of different things. And then if you have more money, you could often go into using stocks and individual assets as well, or a combination of those. All this helps you to be able to invest. So the amount going into there will help you to understand how to do that. But also, it's the skills you need to be able to do that, to pick individual stocks. With the mutual funds, you have professional managers in the funds to begin with. When it comes to individual stocks, unless they're being managed by somebody else, you have to pick those. And that's where financial issues comes in to help you to be able to do that. So it gives you the opportunity to choose the individual assets you wish to invest in, allows you to focus your investing. And again, you can use the ETFs for the broad brush and then pick individual stocks to help fulfill asset classes or overweight in asset classes. So those are the steps I would take. Pretty simple.
That's awesome.
Get your goals, choose your allocation models, and then choose the type of assets you want to invest in.
That's great, Mark. Folks, we appreciate you joining us. We have to leave us. We hope you have a great rest of the day and that you'll join us tomorrow. The rest of you, though, we got a lot more financial issues and time for your calls. Give us a call now, folks. 610-363-1110. We'll be right back after this break.
Make a point. No matter what happens, I'll always be there for you.
I know.
Navigating through investment.
preborn.com/FISM.
Welcome back, folks. great to have you here today. You can give us a call at 610-363-1110. So, Mark, we were just talking about what to do with a lump sum in that last segment, and we had addressed Lee's question. Lee's 64. He has that inherited $41,000. And his question, a little more specifically, Mark, is how can I evenly disperse it over my model? It doesn't say what model he's in, though.
Yeah, there's a lot of vagarity in that. What we need to look at is, again, go back to what we just talked about. The first thing is to understand your goal. Why do you have the model you have? You chose a model, so I'm assuming you have a goal. You realize the volatility, the risks in the model you have. Let's just go with that. And how do you evenly disperse it? Well, the first step is to go back into the partner hub and take a look at the model you're in and look at the allocation model for that, the pie chart on there, and you'll see there's different percentages for each of the different sectors of that pie chart. You then take those percentages and you look onto the buy list, and you just pull up that sector, you sort it by the sectors, and you go, okay, well, this is in this may be in consumer goods, or in well, let's do what everybody's focused on right now, precious metals, commodities. And it says X amount in there. Well, you see there's several commodities, the physical gold, the physical silver, the commodity gold, those kind of things. And you could just divide that up equally among them, or you could say, oh, I only want physical, so divide whatever percentage that is. Let's just, for ease of math, say it was 4%. You could put 2% in each, and then move on to the next sector. So that's how I would do it. If you already know your goals, if you already know your liquidity needs, if you already know your time frame and your sleep factor, and you've chose your models, and go in and look at the sectors and then start investing in alignment with those sectors.
That's awesome, Mark. Folks, give us a call, 610-363-1110. The market's Friday. They rose to finish the week. The S&P 500 eyed another record close, and it hit it. Finished about 2/3% positive. The Dow Jones was 0.5% up, and the NASDAQ was up almost a full percentage point here. Mark, we can go to the phones now. We've got Nelson, and Nelson's calling from Louisiana.
Well, good morning, Nelson. Welcome to the show. What's on your mind this morning?
Good morning, guys. Happy New Year's. I have a comment about the Roth rules. I've struggled with this over the years, and I've researched it every year. There's a difference between a standard Roth where you just put money in it after tax versus a conversion into a Roth. If you just put after-tax money in it, there is no 5-year holding period for the principal, only for the gain. However, on a conversion, that's when that 5-year principal rule comes into play. And then if you can comment on that. And then also, I have a question about selling long-term losers in the portfolio.
Okay. Well, why don't we get to that, and then we'll talk a little bit about the Roth.
Okay, just to set everybody up, we have a lot of new partners. I've been a partner for 8 years, doing great. 20% gains average over the last 5 years. Very happy with the whole program. My first mistakes when I started out was buying and selling too often, but I've come to the point where I'll have held a position for, let's say, 2 years, and it's been a loser for 2 years. So I've made the decision to go ahead and take the loss and move that money that's left into something that would be a potential gainer, and not even worried about recovering the loss, just getting out of a failing position, which everybody should realize that every pick doesn't work out. So that's a truism also. So I'll let you comment on that.
No, I like what you're saying there. There's a lot of stocks that, and there's a lot of stocks that seem to take several years to turn around, sometimes more than necessary, I think. I understand where you're coming from on that. I don't have any concerns with your desire to do it like that. One of the things that we're here to do is to say, okay, this stock is still made of steel and has the potential to turn around or whatever, but we're not telling you that you should buy into it. What we're telling you is, from a long-term perspective, this has the ability to do well. From the short term, it doesn't look like it's doing well, and it could take a few years. You've heard me say that several times. And my encouragement there is that for those who really don't want to hold things for 2-3 years to break even, go on and move on. Absolutely. Because I feel that way about many stocks as well. That's why we oftentimes will go from a buy to a hold, because they're in that situation. Now, the hold doesn't mean that you need to hold them forever. It just means that there are things in it that are, maybe they're overvalued, or maybe there has been a breakdown in the fundamentals, and maybe you don't want to wait for those. If there's a better selection, go for it. I agree with you totally on that. So there's no issue between financial issues, philosophy, and what you're thinking about there. So, and you're absolutely right. You can withdraw on the other issue. You can withdraw your original contributions at any time. And so that is where there is a difference. This question started off with a lump sum, and that's why we were thinking on the line of, well, if it's a lump sum in a Roth and it's being converted, and we should have pointed that out better. Thanks for catching that. That was a really good catch, actually. Appreciate that, Nelson. And thank you for being a longtime partner. We appreciate that as well. God bless you, sir.
Nelson, it's great to hear from you, brother. 610-363-1110. You know, Mark, I failed to mention that the markets just opened and they are down slightly as we open this morning. The Dow Jones down a bit further than the other two major indices are. But we saw some interesting news, Mark, over the weekend. Apparently, Jerome Powell is under criminal investigation. Very interesting here that we're seeing this. No surprise with the back and forth between Trump and Powell. But, Mark, what do you make of this here? And, Sam, am I getting that right there? That Powell's officially a criminal now? Is that is that true?
Well, he's under investigation.
I'm kidding.
Got to let the process play out.
Yeah. What was the reason for this, Sam?
For building his Palace of Versailles, the Federal Reserve, $2.5 billion renovation. What is it? It's like $700 million over budget. They're putting in the marble and the water fountains and all that. Now, Powell says that that's not what this is about. He says that this is because he refuses to lower interest rates, or rather is not lowering them as fast as Trump wants to. He said, quote, "The threat of criminal charges is a consequence of the Federal Reserve setting interest rates based on our best assessment of what will serve the public rather than following the preference of the president." So he's saying this is all a political attack and really has nothing to do with the renovations.
Mark, what do you think?
Makes me sick. Bottom line. Who has oversight over this? What audits have been done? How much is he putting into it? 1.5? No,
2.5 billion.
2.5 billion.
2.5 billion.
And that's over budget. That's $700 million over budget.
And this is a renovation. It makes no sense whatsoever. Obviously, there's all sorts of craziness going on this. We need to be auditing it. We need to have a money trail on every dollar that went through there. We need to see who authorized it. And why in the world would somebody think it's okay for them to build this during a time when inflation was going through the ceiling, during a time when the average American was having negative wage growth during the last administration, not this one. We've had positive during this one. Why in the world would they think that's okay to do? Why do they need offices that make them like kings of the world? This is ridiculous. Why, when the average person has a small 10 by 10 office to run their multi-million-dollar or billion-dollar business in, and they have smaller offices than that? Why do they think this is okay?
It's a stressful job, Mark. They need to take a stroll on the rooftop terrace to cool off.
This is disgusting, and it's opulence, and it's wrong, and we need to hold them to the fire. We need to find out where that money's going. I don't know spending $1.5 billion on a renovation of a small building. I mean, small compared to, say, the high-rise buildings in New York, which cost maybe tens of millions or hundreds of millions to build, but he's going to spend $1.5 billion. That makes no sense whatsoever.
2.5.
It's disgusting.
That's
it's absolutely disgusting. We need to hold their their tails to that fire, and we need to find out where that money went and is going. That's my 2 cents worth.
You know, we were looking at this before the show, guys, and Sam, I think this was in the same neighborhood of the money that it took to build One World Trade Center after the 9/11 attacks, which is the tallest building in the Western Hemisphere.
I think so, yeah.
So you're talking, great, like you said, Mark, lavish money.
Well, one of the reasons being compared to Versailles is not just because it's lavish. I think they're saying that this actually costs more than the Palace of Versailles if you adjust everything for inflation.
Yeah.
Yeah, it's absolutely ridiculous. It's wrong. It's ridiculous. It's opulence. It's arrogance. It's totally wrong. And it shows one of the things that's wrong with having people like that and an organization like that has no accountability over it.
You know, Mark, I think it's really important for us when we look at a story like this to take stock of our own hearts and understand that good stewardship begins in your own heart. And perhaps what we're seeing at the Fed with this kind of spending is maybe the result of poor personal stewardship. And so we can see, thankfully, God gives us the grace to be able to be good stewards in the most important part personally where it starts, which is in our own hearts. That's what we're trying to, show you all how to.
Well said, Seth.
Thank you,
Well
Mark.
said.
610-363-1110. Folks, you can become a partner with us at financialissues.org. Learn more about our strategy there. We'll be right back after this break. More questions to come on the other side.
I remember my life before I met Jesus. I was most of the time afraid. I remember one of my teachers gave the classroom an invitation for Crossroads. When they talked to me about the love of God, I felt a sort of peace in my heart. I will commit myself to learn more about God's Word, to be able to share the gospel to others.
To help reach more kids like Louise with the life-changing hope of the gospel, visit reachOurSchools.com.
In the last 10 to 15 years being in ministry, being married, something that has been constant in our lives is Samaritan Ministries. As we've moved, we've had babies, we've had different things come up, we have just been able to rely on Samaritan in ways that we never really even thought about before becoming members.
Our heart's desire is to plant roots and be in a place for a really long time. It's how we were raised. We see the benefits of that, but we also see the open-handedness of being used by the Lord wherever He calls, because we just assumed when we started pursuing church planting, the quickest way to get from point A to point B is a straight line. And with the Lord, sometimes you find out it looks a lot more like this. And yet, Samaritan was with us through the entire thing.
We didn't have to look into, we have to change insurances now because we've moved states or whatever the case may be. And it's just been a real blessing to us in different phases of life.
I'm Kyle.
I'm Colleen.
And we're the Gen X.
And we're Samaritan members.
My baby was like this big, and I saw his heart beating on the screen. I went from, I don't want this baby, to talking to my child on the screen. That sonogram changed my life. I went from just Candace to Mom.
To find out how you can support the life-saving mission of Preborn, go to preborn.com/FISM.
The opinions and recommendations expressed on this program do not necessarily represent the opinions of the station or any of the program sponsors. Additionally, all products or services offered by the program sponsors may not be known by the program.
You know, guys, I was hoping that we could try to get to that story in relation to Preborn. I don't think we'll have time to get to it today, so maybe we'll have to tee it up for tomorrow's show because we got a lot of questions and we got the phones, Mark. 610-363-1110. We got a call coming from Virginia. It's Frank calling from Virginia, Mark.
Well, Frank, thanks for calling in. What's going on and what's on your mind?
Thank you. I appreciate you taking my call. I was really saddened when you told us we had to sell the SETM. And I was just wondering if you know of another company that does the same kind of thing that you might be able to recommend.
Frank, you and I are in the exact same boat. It broke my heart. That seemed like the perfect ETF to use. You know, it just had everything in it for the new technology, for all the minerals that are needed, for the rare earth minerals, for everything that was needed for it. Unfortunately, there isn't another one that I have found yet. So what I'm trying to do is piece together several stocks that we might be able to buy into. The issue there is buying into these stocks isn't the same as holding company or an ETF that holds minerals and things like that. So we'll have different risks involved. And I want to make sure that there's clarity in all that before we introduce the alternatives there. So, Frank, me too. My heart sank. It sank just like it did on Tesla or NVIDIA. Yeah. You know, it just breaks my heart that these companies cannot stay focused on what they're supposed to be doing and not let their egos and their anti-God, anti-family, anti-Americanism get in the way. So anti-baby.
And you know, Frank and Mark, what's so sad about it too is it's not only does it hurt us, the investor, it's also going to hurt the company too. I mean, they're shooting themselves in the foot doing things like this. And the hope and prayer is that they realize it and that they turn course. You know,
if I remember right, there's very little in there that caused that to happen, but still, how much poop do we want in our cupcake?
Right.
You know,
exactly. None.
That's the bottom line. Yeah. So, but thank you, Frank, and thank you for honoring God by moving on with it and realizing that He's got a plan. He is God. He's all knowing. He's all powerful, and He's going to make it work no matter what. He's going to care for us, and he's got a perfect plan that we get to participate in. And thank you for participating in the plan with honor to God. All righty.
That's great. Appreciate you, Frank. 610-363-1110. Mark, we got a question coming in here from Robert. And so Robert's piggybacking on a question that you answered last week. He says, I have a 401k with my current employer, and I'd like to move those funds into my Roth IRA so I can control where it's invested. Currently 60 years old, and I'd like to move all the funds over within the next 2 years if that is legal to do so. What are the limits to how much I can move per year? We just talked about this, didn't we, Mark?
Kind of, but it's a great question, actually, Robert. Yeah. Robert, here's the deal. This is not, let's make it clear, this is not a conversion. This is actually a contribution. There's no annual dollar limit on how much you can convert from a traditional 401k from a Roth. So the Roth is a conversion, not a contribution, is what I meant to say. I'm getting my words backwards here. So, and there's no limit on that. That's the good news about it. So the IRS contribution limits don't apply to conversions, bottom line. The real limiter is the tax you're going to have to pay as you convert it, not whether it's legal to do it or not, because it is legal. So what you need to look at is how much you can afford to pay in taxes this year. How much will the conversion bump up your income, because all the money you convert from your 401k, unless it's already in a Roth in the 401k, how much in your 401k that's not in a Roth being converted to a Roth and adding to the income that you have to report, how much of that can you absorb without it being overwhelming to you? So that's the reality check for you on it. I believe that's actually the real question there, right? What are the limits and how much can I move per year? You can move it all if you want, but you're going to have to pay tax on everything that's not already in some sort of Roth. So that's the bottom line on it. So you need to check and see. Again, I know I'm going a little bit in circles with it, but I just want to reemphasize. If you convert a whole lot in 1 year, all that goes on top of your earned income for that year. You have to pay income taxes on it that you converted from the 401k, traditional 401k, to a Roth. And you need to decide whether you can absorb that or not in that year. If not, back it up a little bit and do it over a couple of years.
It's great, Mark. Next one we have is Maritza. Short and sweet question here. She's asking, hey, Mark, what is a closed-end fund?
Oh, that's a great question. We don't get that question much, and we don't use many closed-end funds, so that makes sense. A closed-end fund, what they do is they raise capital initially once through an initial offering, kind of like a stock even, and then it trades on the exchange with a fixed number of shares. So once they establish the fund, the closed-end fund, it then trades like a stock on the open market. And it's, if more people want it, then the price of that stock will go up. hopefully the characteristics within it, the companies that it owns in it, will influence the ups or downs, and that's usually what makes some more people want it. So that's really what it is. Many closed-end funds actually just focus on income. And here's the thing that you might want to be a little concerned with. Find out if they're using leverage within it to increase the income. It can increase the distribution, but it also can magnify losses if the companies within inside it, whatever they're doing inside it causes problems. So that's the bottom line. A closed-end fund should serve as long-term stewardship goals, not day trading type of things is the bottom line of it. So occasionally we could find, and I believe we have in the past, find some closed-end funds for income that were stable, didn't use much leverage, that did provide income for the income model, and we'll probably find some more in the future as well.
It's good stuff, Mark. Brock is up next here. Brock's saying, Mark, I'm looking at a loan for farmland in March of 2026. The rates are largely controlled by the 10-year Treasury, not prime. I'm looking at interest rates now and what you anticipate over the next several years. Would you take out an ARM at 3 years at 6.3% or 5 years at 6.6% or a fixed year at 7.4%? I have a sense that rates will go down over the next couple years, but long-term over 5 to 10 years, I believe they'll increase. What do you think, Mark, for Brock?
Well, Seth, somehow I think you know what my first comment's going to be.
No crystal ball, right?
No crystal ball. I don't predict the future.
What about a magic 8 ball? Could we settle for that?
That's a little closer to how I would predict the future. Probably is as helpful as that, too.
Right,
but, only God knows where it's going to go. But what we can do is weigh the possibilities, the probabilities, the risk, and the stewardship priorities of all this. So interest rate environment. Yes, I do believe there's a reasonable possibility that rates could come down some over the next year or so. That doesn't mean it's so. I just think there's a high possibility with the administration we have in right now, with their desire to bring down the interest rate, not only for you and me and everybody in America, but for the government itself to be able to handle its debt. So that said, it's a possibility, not a certainty. And borrowing decisions really shouldn't be built on forecasts. I mean, at least just forecasts alone. I really think that should be a mistake. First of all, let's talk about an ARM versus a fixed. That's the real decision. This isn't about just the rate, but it's about choosing between interest rate risk and predictability. Okay, obviously ARMs, annual renewable, when you have a 3-year or 5-year, they lock it in for the interest rate for 3 years or 5 years. But after that, every year it changes. So let's just say at the end of 3 years, everything went wrong and interest rates are through the ceiling. After 3 years, your interest rate is going to jump big time. They usually have some limits on how much it can jump, but those limits are quite wide. So you have to determine right up front, if worst case scenario happens, and I take out a 3-year ARM, can I afford it? Can I handle it? Do I believe there's no risk for me defaulting or panicking or losing sleep or whatever? So that's why we say it's very important to figure out what's best for you. Is you have to know what you can handle under worst case conditions with ARMs. Okay, with fixed rate, it is a higher rate today, but it's totally predictable. If you can handle it today, you'll be there's a better chance that you'll be able to handle it in the future. And that often aligns well with long-term land ownership and stewardship. But Brock, the right answer is the one that allows peace, faithful land stewardship, and avoid speculation. I'm not saying you shouldn't do the ARM. You just have to evaluate that in your life and know that you can handle worst case scenarios on that. That's all I'm saying. Be wise about it, use prudence, and find that place of peace. When you think you have the answer, go before God and see if he gives you that feeling of peace, because it's only God's directives that matter in our life. That's why we want to invest in a way that honors him. That's why we want to honor God in all we do. And that's why we're so blessed by having partners like you who want to honor God in all they do, including investing with biblical integrity. God bless you all. I look forward to seeing you tomorrow.
If we ever forget that we're one nation under God, then we will be a nation gone under.
Thank you for joining us. This has been an FISM production.